Now, good morning, everyone. It's 10 o'clock, so we will call the August 14th, 2025 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the meeting minutes from July 10th, 2025. I have a motion and a second. Please record your vote. Item is approved.
Oh, wait.
Oh.
Doug's vote. Oh, never mind. I was seeing Bruce. It looked blank. Go ahead. Sorry.
Item is approved. Item number 3 is a consent docket. We have 6 items that we can take with one motion. I have a motion and a second. Please record your vote. Item is approved. Item 4 is to ratify approvals. We have a motion and a second. Please record your vote. Item is approved. Item 5 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item 6 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item 7 is to approve continuation of pension to spouse. I have a motion and a second. Please record your vote. Item is approved. Item 8, receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. I have a motion and a second. Please record your vote. Item is approved. Item 9, receive report of death, authorize payment of the $5,000 death benefit, and authorize the secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. I gotta scroll here a little bit. Which one did I miss? Item number 10 is to receive report of death, authorize the secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item 11 is items for individual consideration. Item 11A is to approve the purchase of audio-video conferencing equipment and installation services using the City of Oklahoma City's purchasing contracts to add video conference capabilities to the ERS Administration Office. Estimated cost not to exceed $10,000. Anyone have any questions? Hearing none, Chair will entertain a motion. I have a motion and a second. Please record your vote. Item is approved. Item 11B is authorize Board of Trustees, retirement staff, and city employees traveling on behalf of OCERS to attend the Oklahoma Public Fund Trustee Education Conference, October 1st through 3rd, 2025 in Broken Arrow, Oklahoma. Any questions? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item 11C is a resolution adopting the Records Retention Manual of the City of Oklahoma City as they exist currently or as they may be amended, and adopting the Oklahoma City Employee Retirement System Supplemental Attachment. Anyone have any questions on that one? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. Item 11D is a resolution authorizing and directing the chairman and/or his designee to negotiate a multi-year contract with Pension Technology Group, LLC, to provide a new pension management system, including implementation and configuration services. This has been a project that has been in the works for several months, and as the memo indicates, we did software demonstrations a few weeks ago. Those on the selection committee have decided to attempt to get a contract with Pension Technology Group for our new system, so this gives us authorization to negotiate that contract. We're still on the PeopleSoft pension system that went into effect fiscal year 2002, 2003, so it's definitely time to upgrade. Any questions? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. Item 12, item 12A is to receive the monthly investment report.
Okay.
Morning, Jason.
Morning. Maybe can we start with the quarterly report, if that's okay?
Sure.
And then we'll
Sure, that's item 12B.
we'll move forward one. Sorry about that.
That's all right.
Just go back in time a little bit. So we've talked a lot about this as over the last few months. It's a bit surprising to see how strong equity markets are this year, despite tariffs and other issues. Where we sit at the end of June, pretty strong equity market returns. We did see both the S&P and the Russell 2000, or small cap in the U.S., fall into bear market territory in the first quarter, down 20%. At least with the S&P 500 rebounding to new record highs. Again, this week, two new record highs on Wednesday and Thursday. Finally, have seen small cap rally a little bit, but one of the things I want to point out, and as you look at this page at broad market returns, if you go out over to the 10-year, and this is at the end of June, the S&P 500 is really double the return of every other asset class. So at 13.65%. Small cap, the Russell 2000 is up 7%, so really the second best asset class over that 10-year period. You see the ACWI at 10, but most that ACWI is about 70% U.S. large cap, 30% non-U.S. So it's a global benchmark that is heavily dominated by U.S. large cap. So really over the last decade, the more U.S. large cap, and in particular the Mag 7 that you had, the better you looked. And we've talked about this quite a bit. And so relative returns right now relative to your policy index, your policy index, we're using the S&P 500 as the policy index for a good portion of your portfolio. Private equity, and when you, prior to the elimination of the long-short equity, we were benchmarking that to the S&P 500 as well. Relative to peers, we'll show you some peer group data for all public funds, and then public funds greater than $1 billion. And I know you're not greater than $1 billion, but you're close to that. But more importantly, your asset allocation looks a lot more like large public pension funds in terms of your allocation to private equity and real estate, which tends to lower the allocation to U.S. large cap equity that we see a lot in a lot of smaller plans. So on a relative to some peers, smaller peers that probably had more, that do have more U.S. large cap, you can see what the impact of that is from over the last 10 years. On a go-forward basis, our capital market assumptions, we continue to believe, there is a reversion to the mean over time. We have seen that this year in a couple of areas that have been laggards over the last decade. Non-U.S. and emerging markets, year to date, they're the best performing asset classes. I had a question yesterday from Brent, and just happens to be in this book, about the impact of currency. So what you'll see on this page is the EFI net div. This is the non-U.S. developed market benchmark when converted back into dollars. The EFI local currency, those are the same companies make up that index. It's just in their local currency. So you see on a year-to-date basis, this is the first 6 months of the year, for U.S. investors, because the dollar declined so much this year, that was a big tailwind for U.S. investors investing outside of the U.S. That had about a 11% increase to the return of those companies in that index for U.S.-based investors. So a big part of that is coming from currency. The same is true on EM. We don't show the same thing on EM, but the same thing is happening there. Over the decade, while non-U.S. did not perform as well as U.S., the actual companies actually had been doing quite well. You'll see that 10-year return of 7.5%, so that's above what most investors' required rate of return is, compared to the S&P, still about half the return. And then the impact of currency over most of that time, we had a strong dollar, so that was eroding the return a little bit. But that diversification certainly benefiting you in the near term. So we just go to your portfolio, a couple of things, looking at dollars, because I do think this is important. We talk a lot about relative returns, relative to benchmarks, relative to peers. Most importantly is you use dollars to pay benefits, and you have to grow your assets over time to meet your liabilities. If we look at this, the 10-year period, and I do think it's important for trustees to keep the long term in mind. We know that there's going to be short-term volatility and short-term dispersion relative to policy benchmarks and peers, but over time, are we meeting our objectives? You can see the last 10 years have been very strong in terms of portfolio growth. 10 years ago, so this would have been July of 2015, the portfolio stood at $667 million. Net additions over that time period, negative $283 million. So this is contributions that come in, less really benefit payments and other expenses, but it's mostly benefit payments going out. So that's a negative $280 million in cash flow. We would expect a mature pension plan like this will always be in a negative cash flow position. You're paying out more than you're bringing in from any year to year. That said, and that's what your investments have to grow at your rate, which is around 7% is your assumed rate of return now. From a return on investment standpoint, over that decade, your assets have grown by a little over $500 million, $548 million. The last year, just under $100 million. So at the end of June, the portfolio stood at $932 million.
Jason?
I'm not sure if we ever got over $1 billion.
So if we look at the 1 year here where our net additions was a negative 31 million, so we paid out $31 million in benefits in the last year. But we ended the market, I've never really thought about this. That's 3% of our value at the end of the year.
And that's about what we would expect. And
Okay,
you know, I don't want to say that that's exactly what your benefit payments are.
right.
So this is money, I mean, the timing of this relative to like accounting numbers probably doesn't match up.
Right.
This is what's come out of the custodian accounts over that. That's the net money in and net money out of the custodian accounts. So it might not match up exactly if you
Right.
looked at an accounting basis, but yes. So if you think about a 7% return hurdle, we're expecting you're going to spend somewhere, but you know, the outflows are going to be around 3 or 4%. Inflation, 2.5 to 3%. That's kind of where you get a return expectation needed, a return requirement of somewhere between 7 and 8% over time.
Jason, I've got a question. Is that negative just for benefit payments, or does it take into consideration
It's simply money.
fees that we pay, the staff
Sure.
expenses?
Well, it's money coming out of the custodial accounts that we're measuring. So
Okay.
there may be other expenses that, that's why I say it's not an accounting number. Because there may be other expenses you're paying that come out of another account, of a checking account somewhere, or straight from the treasury.
Okay.
So it's not an accounting number, but the best way to think, most of that
Yeah,
is
vast-
being,
yeah.
being used for benefit payments.
Okay.
Think about when we say we have to raise cash for benefit payments. So we're not necessarily moving it out of the portfolio. We raise a quarter's worth of cash. It sits in cash. Then the treasurer's office moves it to a different account to pay benefits and,
Okay.
and other expenses. So, but for the most part, benefit
Yeah.
payments.
Okay, thank you.
In terms of asset allocation, we're roughly in line with the broad targets, a little bit overweight to equity.
Sorry, Jason, I'm just
Yep.
gonna, I just thought about that. There's $31 million out, but we looked at what our payroll was, I heard a minute ago, and it's like $4.2 million. So then it's not necessarily everything that goes out.
And this could be timing.
Okay,
Too.
you're right.
Yeah.
Well, yeah, and Brent, I mean, it's all the stuff that's being held out of our paycheck is sitting there, and they're using that to pay benefits as well.
It's a net.
Yeah.
Yeah, it's that thing.
yeah.
So when you look at it, I'm being sorry, I can't help it, but $4 million a month, that's $50 million roughly a year. But the net was, that actually went out was 31 because we're continually putting money into the bucket.
We're
Right.
funding it.
All right, there we go.
And it could be timing, because this is like looking at, I mean, you might have made, some payments may not have happened until July, but they were really for the June period, so. In terms of broad objectives, the portfolio, we look at a number of different things. The most important being that actuarial hurdle over 5 and 10 years. You've been very thoughtful in bringing your required rate of return down over time at 7%. And over the 10-year period, you've delivered a 7.25% return, and over the last 5 years, an 8% return. You know, I think if we go back in time and we looked at in 2020 or 2021, your 10-year trailing return was much higher than that. If we looking backward, the 10-year return was probably closer to 10% at the end of 2021. That said, just being thoughtful about where future expectations are, they're not dictated by what's happened in the past. Having that return assumption at 7 has been very prudent. And if we look across public pensions in the country, I think the average right now is still right around 6.9% across public pensions. So you're doing well. We also look relative to the policy index. Over the 3-year period, we're a little bit behind the policy index. A big part of that is private equity and small cap right now, because the policy index, as I indicated, is heavily, the S&P 500 represents 35% of that. We don't have 35% of the portfolio in large cap stocks. We're doing some other things there, and that's creating that dispersion. Over 10 years, we're about right on it. The other metrics that we're showing here are all risk metrics. Historically, the position of the board has been we want to participate when markets are up, but protect when markets are down. And how do we do that? We do that through an implementation that has a little less volatility, which is standard deviation. You're going to have a little less variation in returns from year to year, a little less sensitivity to the direction of the market. So when markets are really going up, the portfolio is going to have a little bit less sensitivity to that, may not go up as much. But the same is true when markets are going down. And then we want to capture a little less of the downside. This number here on the 5 and 10 year, the 90% down capture and 92.5%, what that means is when the policy index or markets are going down, if they're down 10%, you're only down over a 10-year period 9.2%. You're down 90. You're not down as much, and over 5 years, only 90%. The importance of that, and you always try to use the example, if you think about it, if you start with $100 and you're down 50%, you have to be up 100% to get back to even. So we want to try to control the downside as much as possible, and you've been able to do that. I was on this page earlier, but asset allocation, we're roughly in line with targets. Where we're overweight is large cap, overweight the target at 20 versus 15. That's really the underweight to private equity because we've increased the target to private equity. We've slowly been increasing that target. I think we just recently did it again this year from 10 to 15%. It's going to take some time to get there. So being overweight large cap has been helpful. But if we looked at the market as a whole, and particularly right now, and I'll use the Russell indices, the Russell 1000 is the 1,000 largest companies in the U.S. market. The Russell 2000 is the next 2,000 largest, so we consider the 2,000 to be small cap. The Russell 1000 makes up about 85 to 90% of the U.S. market cap. And small cap, the Russell 2000 makes up about 10 to 15% of the market. If you think about the weighting 15 and 10, that's a little bit over, it's in the portfolio, we have more, small cap is representing more of the portfolio than the market opportunity set. And then we add in private equity and it's a little bit more because private equity tends to be smaller. In the short term, relative to a portfolio that has more large cap, that's been a bit of a headwind. Longer term, over longer periods of time, we would still expect a premium from private equity for illiquidity and small cap. However, that hasn't necessarily been the case recently. So getting to peer group data here, looking at 10-year numbers again, the 7.25% relative to the policy index, about right on top of that. Standard deviation, this is risk. You've got there with quite a bit less risk from a risk-adjusted standpoint, Sharpe ratio. It's a more efficient portfolio than the policy index. The peer group ranking, and we're showing two. As I mentioned, the first one is public pensions greater than $1 billion, and you're in the top half, top 40%, so outperforming 60%. All public pension funds right at the median, at the 56th percentile, so a little bit below the median. But you can see, particularly in the near term, if we look at the 3-year number is really where we're seeing it. That's a pretty big dispersion between the broad public DB universe and the greater than $1 billion. It's over 100 basis points. And that's really where we've seen this deviation, where large cap has dominated and real estate and private equity has lagged. And if we look in your portfolio, you have more of that. And that's what we're seeing on that relative basis. This chart in the lower left, this is looking at calendar year returns. So this is not June 30, these are 12/31. But I do think just looking at in terms of how strong the market's been. We've had a number of years where the returns have been significantly above your required rate of return, but there's been a couple where we've fallen, where the markets have fallen below. And you know that you're banking surplus in these years where you're getting over 7% to offset what's happening in years like 2022. Now I will move to the monthly report, just a little easier to. So here I can break down a little bit easier where returns are coming from or where that dispersion is coming from, and this is as of July. So total fund through July up 7.83% net of fees, the policy benchmark up 9.5%. Where we're seeing that dispersion, a big part of it, this 10% is up 10%, private equity. It's being represented in the policy benchmark by the S&P 500, which is up 16%. So that's creating that dispersion in the short term. The other piece right now is small cap. Small cap has been a bit challenged. I was going to point out on Silvercrest. Silvercrest you haven't had for a very long period of time. It's a little less than 3 years. It's been a tough 3 years for them. However, the last 9 months, Silvercrest is in the top quartile of the peer group through June. They tend to, when small cap really rallies, they rally significantly. So the quarter ending June, they were up 13%, and they were in the top third. Then we saw small cap sell off again in July, and they lagged. They have a little bit of your managers, they tend to have a little bit higher beta. Long term, the results for Silvercrest, as well as, and they're not in all of these numbers, but if we go back and look over 10 years, your small cap gross of fees is about 60 basis points ahead, a little bit behind net of fees. Most of that's coming in the last year. Your small cap has been additive over time. Fixed income, it's been over a decade. Fixed income returns have been fairly muted, just with lower rates. Where we stand today, rates are certainly significantly higher following declines or rises in rates we saw in 2022, with yields moving up about 4.5% to 5%. And a lot of talk about where rates are going now. We're still significantly higher than we'd been any point in the last decade. And so you're actually getting some contribution from fixed income in the portfolio. On a 1 year, your fixed income's up 4.5% relative to the benchmark, up 3.4%. Real estate starting to come bounce off the bottom. We are seeing positive returns in real estate the last few quarters. More importantly, the purpose for real estate in the portfolio longer term is to provide a premium return to fixed income with less volatility than equities. Despite what we've seen in the last couple years with challenges in the fixed income market, the 10-year return is over 5%, whereas bonds is 2.25% and less vol than equities. So we believe that the case there still makes sense. No specific manager issues. The smaller cap pieces in the portfolio have been challenged. We don't think they're broken. Even on the EM side, we have a very small piece, about 1.5% of the 5% target here is in Wasatch, which is small cap EM. A couple things with that. The smaller cap has not done as well. That strategy also is overweight India and underweight China. China has been the best performing country in emerging markets, and they don't have much exposure there, and so that's been a bit of a headwind for that Wasatch strategy. Nonetheless, on a just contribution to return, we see EM is up over 14% for the year.
Jason, I have a question on this. The percentage return on your total portfolio on the net of fees, since inception, you have the total portfolio at 6.85, but the net of fees is 7.85?
Yeah, those are probably, I'll get back to you on that.
Okay.
What I think that is are different time periods.
Okay.
And that we're not noting that because I know we started calculating net of fees.
I mean, heck, if you're going to give us 1% a year just from your pocket, we'll take it.
No,
Amen, yeah.
began calculating net of fee manager returns in January of 2012
It's been a while, yeah.
because your fees historically, and maybe they still are, were paid out of a different a checking account that we did not see. So beginning in 2012, we rectified that so that we could capture all net of fee return data. So this 685 is going back to January of 2002. That 785, I'm not sure when that goes back to. So that,
Probably should have a footnote on
yeah,
that.
you're right. Yeah,
Okay.
we will.
Thanks.
We'll get that.
Anyone have any questions for Jason? Thank you, sir.
Thank you.
Chair will entertain a motion on item 12A to receive the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. And now item 12B, to receive the quarterly investment report. I have a motion and a second. Please record your vote. Item is approved. Item 13 is comments from board, staff, and citizens. If you plan on going to the trustee education conference and you haven't let Gina know yet, now would be a good time because we're 6 weeks or so out, so. Anything else? Okay. We are adjourned at 10:33. Thank you, everyone.